All attendees are in listen-only mode.
Good afternoon, everyone. Welcome to AVPN webinar, Impact Investment Ecosystem in India. My name is Maushmi and I'm the Director Development AVPN India. AVPN is a unique network, funders network, headquartered in Singapore, committed to building a vibrant and high-impact philanthropy and social investment community across Asia. For today's webinar, we are pleased to have Mr. Sameer Gaur, Associate Director, Intellecap Investment Banking Group, and Mr. Sarvesh Kapoor, Vice President, Intellecap Investment Banking Group. While Sameer heads the healthcare and consumer practice in investment banking at Intellecap, Sarvesh heads the agriculture and clean energy practice along with focus on financial services. Through this webinar, they will share their insights on the impact investing ecosystem in India, highlighting emerging trends, deep diving into the sectors that are investable, and present some key stakeholders in the Indian market. Before we proceed, some housekeeping instructions. We will not take any questions during the presentation, but will open up the floor after that. Please feel free to type in your questions during the presentation and I will raise the same after the presentations end. If you have further questions which are not answered by the end of the webinar, you can email us at india@avpn.asia. I will now hand over the presentation to Sarvesh Kapoor and thereafter Mr. Sameer Gaur to take us from Intellecap, who will take this forward.
Thank you, Mosmi. As Mosmi just mentioned, we would talk about the ecosystem of impact investing in India. We would talk about the emergence of impact investing in India. Then I would take you through the unique factors as well as the key drivers that impact investing in India we see. Then we would highlight a little bit of the key challenges in the impact investing. And then Sameer would take it forward to discuss the key stakeholders as well as we'll talk about the key sector themes that we see. Next slide, please. Thank you. So talking about the emergence of impact investing in India, as most of us know that India is now seen as the leading hub for impact investing, which has a very well developed ecosystem across the value chain. And it's considered not just one of the largest impact investment market in South Asia, but as well one of the top in the world. How did this all happen? Just to give a brief about the same, the impact ecosystem in India is not new. It's not just a decade or 2 decades old. It has a long history. In fact, pre-independence, that's pre-1947 also, we had a lot of entrepreneurs who wanted to achieve the good for the society and they were inspired by the Gandhian philosophy for the preservation of the human dignity, etc. And earlier these models were not for-profit models, but they were philanthropic models. And the idea was basically selfless service rather than for-profit motive. The key turning point in the Indian entrepreneur story happened in the 1991 when the economic reforms were taken by the government of India and they started to ask the private enterprises to participate freely. They moved the license Raj, the so-called license Raj that we have, and a lot of private companies started to flourish at that time. Looking at this, the government also established SIDBI, that is the Small Industrial Development Bank of India, which provided support to small and growing businesses at that point of time. And interestingly, the IT revolution in India also started at the same time. And a lot of startups started to come up at that time in the IT sector. And a few VC firms, for-profit VC firms rather than impact funds, started to recognize this and started investing in these companies as and when they started to come up. Looking at all this, we also saw the emergence of impact investing come up, or impact investors started to come in India, looking at the opportunity because we had a very large base of the pyramid, bottom of the pyramid population, 800 million odd people. So individually, they may not have a good capacity to pay or a large market, but cumulatively, they have roughly about $360 billion of disposable income that was very attractive for a lot of people to see if they can do something with this kind of a market. We saw a lot of homegrown investors come up during the early 2000. Avishkar, one of the first impact investors, they launched the fund in 2001. We also saw some international investors coming in, with Acumen being one of the first, again coming in 2001 odd. That's how the impact investing landscape started. From then to today, there's been a very, very long journey and a long way. We've got 220 plus impact enterprises in India that have got funded. Roughly $1.6 billion have been invested in these companies. Roughly $487 billion in its first round, and $1.5 billion in follow-on rounds. And interestingly, it's not just the impact investors who invested in the first round, but we've also seen mainstream investors investing capital in the first round. 52% of capital invested in the first round has been by mainstream investors, compared to just 30% by impact funds. But the number of deals done by impact funds are far more than the mainstream investors. 136 odd deals done by impact investors compared to 58 odd deals by mainstream investors during the first round of funding, which means that the impact investors do far more number of deals, but the average ticket size that they invest in is far lesser. And the mainstream investors, of course, have a larger pool of capital and they invest far more money, but obviously in much lesser number of impact investor enterprises. Moving on to the next slide. So here we will talk about the unique factors of the impact investing that we see in India. Essentially, what we see is that it is rooted in the local context. What it means is that we've seen that the companies or the entrepreneurs need to have a deep understanding of the local context to come up with the right solutions for that market. It isn't possible to just cookie cut an approach from, say, a different industry or a different geography and just replicate in its area. Each area in India has its unique factors, and you need to have a lot of local sensibilities to take into account before you can come out with solutions that would work in that geography. And what we've seen is a lot of these successful companies, they've done this, they've successfully demonstrated the model in a locality or a region, and they've then scaled it by replicating this in different regions. But obviously they again have to take into the local sensibilities in that region when they take it. It's again not a cookie cutter approach. That's how they've achieved scale. The other key characteristics that we've seen is that there is the entrepreneur in India is basically the center. A lot of companies do well, but what the investors see is the ability of the investor, the ability of the entrepreneur, how he can run the business, what are the different ways in which he solves a problem, his experience in doing those things. Because as explained earlier, that you have to in fact take one model from one successful region to the other region to scale, but you have to keep innovating yourself as and when you go into new areas to take into the local sensibilities there. So essentially they look at the ability of the entrepreneur to keep changing itself, and hence the business would be successful. The other unique factor that we've seen is the fact that how the impact investing landscape works in India. Basically, initially, as most of the enterprises are initially funded by impact investors, these impact investors then help these companies scale. They change the business model depending on the needs, help the entrepreneur to grow also, and then they showcase these to mainstream investors when they can invest further. Mainstream investors, of course, are not so much driven by impact, but by scalability and profitability, which is only then they invest. And that's what we've seen, that the impact investors invest in the company, make them ready for scale, profitability is seen, and then mainstream capital is unlocked into these companies. And then in various cases, the mainstream investors and the impact investors work together to take the company forward, which is unique in the Indian context. The other factor that we've seen is that there is a lot of focus on accountability in India. maybe because the impact investing landscape is such that you have very few amount of capital that each company has. There's a huge sense of accountability. The impact investor wants to see where all is the money being spent by the entrepreneur. Is it being spent in areas where he had said, is it being spent well enough to create impact or not? And we are also seeing a lot of transparency that the impact investor wants from the company. And perhaps that's because of the MFI crisis that we had seen in India during 2010. Post that, there's been a lot of emphasis even in transparency rather than not just accountability. Moving to the drivers to impact investing in India. What are the key drivers that we feel are impacting impact investing in India? Obviously, one of the key things is that India has a huge bottom of the pyramid population which lacks access to basic services. Just to give a little bit of numbers, 32% of Indians earn less than $1.25 a day, and 37% earn less than $2 a day. So essentially, 67% of Indians earn less than $2 a day. That's a huge market. What we've seen is that most of the investable companies per se look at services that can be paid by people who earn more than $1.25 a day. That's the market for them, rather than people who earn less than 1.25. Those very poor, ultra poor people, they essentially have to depend on government grants and subsidies rather than their ability to pay. Hence, a lot of companies focus on people earning more than $1.25 a day. The other driver we've seen is the fact that there is a low public spending for the social sectors in India. The amount seems to be high. For example, India spent $100 billion in 2012-13 for the public sector. But because of the sheer size of the population, it's just too small because of that. In fact, the $100 billion was less than 1% of India's GDP in 2012-13, and compared to certain other developing countries like Brazil, Brazil spends 2.84% of its GDP. The Indian spend as a percentage is very small. And of course, the inefficiencies rather add to this low spend, because of which impact investing would be flourishing. Looking at all these, what has happened is that a lot of private sector participation has come up. They've seen the fact that there's a huge market in the bottom of the pyramid that can be serviced. There's a clear need for certain services which the private sector has identified, and they've started to provide those services to those individuals. Once private sector has come up, there's been some successful business models that we've seen. This has led to the emergence of talented fund managers who want to take part in this and become fund managers and invest in these enterprises and companies. What they've done, of course, is they've gone ahead and raised patient capital from DFIs and foundations and started impact investing in these enterprises. Next slide, please. Next, we will talk about the key challenges in impact investing, what we see right now. What we've seen is that the financial return essentially does not reflect the enterprise performance. Many of these enterprises may create a lot of impact, but unfortunately have low returns to show, which kind of gives a little bit of an issue, because the investors essentially want to see return as well and not just impact. So that's one of the challenges that we are seeing. Next, essentially, also the fund structure that we've seen in the market. Essentially, what happens is that most of the funds that are there essentially need exit within 5 to 7 years, because they have to return their capital back to their original investors. But the impact enterprises are such that they need patient capital. They need roughly perhaps 8 to 10 years to prove their model, which means it's difficult for them to show scalability within the period that the fund essentially wants them to do, and that's one of the issues that we've seen in the impact investing space. The next challenge we see is that because of these reasons, there's a lack of funding that is available to these impact enterprises. They are also then forced to think whether they should continue to show impact or should compromise a little bit on impact and start showing more of profit so that impact investors can invest in their company. So that's another issue that we've seen. Lastly, type of funding available is also an issue. What we've seen is that, of course, there is subsidy available, but subsidy is not a smart subsidy, what we say. Many times the company that is giving subsidy has its own needs or own reasons why they're giving the subsidy or programs that they want to fund, which may not be the best thing that the company needs the funds for. And that kind of creates an issue also. So smart subsidy is the need rather than just any kind of subsidy in the sector. Now I would call upon Sameer to take the presentation forward.
Thank you, Sarvesh, and hello everyone. In the next section, we will look at the key stakeholders in the Indian impact investing sector. Now, the basic premise of impact investing ecosystem in India is based on addressing three key issues that are currently prevailing in the economy. The first addresses the access and affordability issue, which is the most common problem in India. The second addresses the capital constraints faced by the enterprises. And the third addresses the networking issue, which is connecting the enterprises to the right set of networks for enhancing their business synergies. And as a result, we have the three stakeholders, which are one, the impact enterprises, which are addressing the access and affordability issues in India. Second are the impact investors, which include impact funds, angel networks, debt providers, and venture capitalists. And the third one are the ecosystem enablers, which are the intermediaries which provide support services to the enterprises. Now, aside from these stakeholders, we also have limited partners which play an important role in catalyzing investments into the impact sectors. And they do it either directly or indirectly by providing capital to the impact investors, which in turn invest in the enterprises. And each of the stakeholder groups, what we have seen is they have grown and evolved substantially during the last decade. And in the next few slides, we will talk about each of the stakeholder groups. Coming on to the next slide. We'll first talk about the central pivotal point of the ecosystem, which are the impact enterprises. Now in India, until the 1990s, most of the impact enterprises that existed had business models centered around philanthropy or cooperative structure, benefiting a certain sector of the population. It was only in early 2000s that for-profit impact enterprise emerged on the scene, and the rapid growth of the impact enterprises began since 2005 in India. Based on our analysis, we see that while the impact enterprises are present all across India, they have a very strong representation in the southern and the western belts of India. Sorry, I'm on slide 7 now. Yeah, so I was saying that based on our analysis, we have seen a very strong representation of the enterprises in the southern and the western belts of India. And this is mainly due to a large presence of financial services in those areas, coupled with the fact that these regions relatively offered a better ecosystem for growth of the enterprises. And amongst the overall states in India, we see Maharashtra, which is a part of the western region, accounts for around 35% share of the total impact enterprises in India. Now, whereas the low-income states in India have not seen very high numbers of impact enterprises, we believe that this region has a very high potential for growth, given the fact that these regions have a large BOP population, and they are also marked with high presence of talented entrepreneurs. Now, a majority of the enterprises today operate in 4 key sectors, which are the financial inclusion sector, renewable energy sector, agribusinesses, and livelihood. So these are the four dominant sectors for the impact enterprises today. Financial inclusion remains the single largest sector, and they accounts for approximately 21% share amongst the overall impact enterprises that exist today. And now this is due to the high demand for capital in these sectors and a significant policy push from the Indian government. One last point which we wanted to highlight out here is the capital constraint that are faced by the impact enterprises today. But before we talk about the financing constraint, it is important to note that in India, most of the impact enterprises are in their growth phase and have not attained, stability or maturity phase. But when you compare it with the South Asian counterparts, I think these are relatively, more mature. Now, the impact enterprises in India, depending on the stage of their, business life cycle, depend on financing needs. Now, they typically seek grants and working capital at an early stage, and a long-term debt, once they attain, a growth phase. What we see is entrepreneurs are facing challenges in raising capital, and that is primarily due to the lack of lender-accepted collaterals. Companies are at a relatively mature phase. Sometimes, they find it difficult to access long-term debt because they are sometimes unable to meet the criteria of the lenders. Sometimes those criteria of the lenders are as, they base it on the profitability matrix, and the history of profitability. And at times, the impact enterprises do not meet that particular criteria. However, with the continued growth of the entire impact segment, the perceived riskiness, in our opinion, is falling, and it's slowly gaining high investor and the lender confidence. We now move on to the next stakeholder, which are the impact investors. To start with, we'll just give a brief backdrop on the emergence of the impact investors in India. Now, in line with the growth of the impact enterprises in India, the investors have emerged in early 2000s. I'm on slide 8 now. Yeah, and have grown since then. Their regional preference for investment is very much aligned to where the impact enterprises are present. And not surprisingly, we have seen very high amount of investing activity in the western and the southern regions of India. Now, this slide here highlights the investment approach adopted by the impact investors in India. At a very broad level, most of the impact investors in India adopt a venture approach for investing. Now, historically, the social sector has been funded through grants, which means that based on the impact and social work, the philanthropists and funds have been providing them support without any return expectation, other than the evidence of good work. However, we see that this trend is changing, and the investors have now moved away from grant-based investing to equity risk investing. On the right-hand side, we'll just very briefly talk about the business models of the enterprises and where the investors see a lot of value. While in our view, there has been a perceptible shift in the preference of business models from an investment point of view. If we analyze the range of business models of the enterprises, we see that at one end, there are enterprises who are reliant on grants and do not have a profit motive. On the other end of the spectrum, we see that there are enterprises which do impact work, but are also aligned to profitability and scalability. The impact investors today prefer to invest in companies that are scalable, profitable, and also sustainable. Now, this is a very unique feature in the Indian context, which is not so prevalent in other geographies. And we have seen that investors have moved away from the traditional approach of high impact and no returns to high impact coupled with returns. So that is what now they are adopting as an investment approach. Moving on to the next slide, we will talk about the sectoral preference of the impact enterprise investors rather. As Sarvesh briefly pointed out, broadly we can divide the impact sectors into two parts. One are the pull sectors and the push sectors. Pull sectors are those which have a high and demonstrable demand, like healthcare, financial inclusion, and agribusinesses. While push sectors are those in which relatively the demonstrable demand is low and it has to be created. What we have observed is that large amount of investments have gone into the pull sectors, and even amongst them, the ones that have a very high scale, which have a very high scalable model, like healthcare, MFI, and agri. These are the sectors wherein we have seen the highest level of investments till date. And at the bottom of the slide, you see some numbers around. So the top 3 sectors are microfinance institutions, which currently account for 50% investments, cumulative. Second are the financial inclusion, non-MFI, which account for 17% investment, and the third is healthcare, which accounts for 11% of investments that have been done in the impact space till date. Moving on to the next slide, we'll talk about the next stakeholder, which are the ecosystem enablers. Now, they are an integral part of the system, and they essentially provide support services for the impact enterprises as well as impact investors. Now, these service providers include investment banks like us, business incubators, associations, forums, and also rating agencies. Now, these enablers primarily contribute in identifying the entrepreneurs and providing them with support infrastructure to give shape to the enterprise, and add tangible value to them. Impact enterprises and investors are what we see are forming associations and organizations to better engage with the larger ecosystem and the government at large. We'll talk about National Association of Social Enterprises, NASE, which was formed in 2012 to establish a networking platform for the members. Now, they also play a role in providing the enterprises access to various government departments and funding bodies. The association also intends to create a code of conduct and develop impact assessment matrix for its members, and it further aims to mentor upcoming social entrepreneurs and create broader awareness about the potential of social entrepreneurship amongst the student community. We also have IIIC, which is the Impact Investors, Indian Impact Investors Council. IIIC is a member-based industry body that aims to accelerate the growth of impact investing in India. And one of the other objectives of the council is the impact measurement, which is one of the key constraints that we face in India currently, and standardization and the policy support and the brand building of the enterprises. With this, we move on to the last section, where we will briefly cover the key emerging trends in the healthcare, financial services, and the agri sectors. I will take up the healthcare section and will hand it over to Sarvesh for the other sectors. Talking about healthcare sector, in the last 5 years, both the mainstream as well as the impact investors have invested close to $5.8 billion in healthcare and the pharma sectors in India, out of which healthcare delivery and the pharma accounts for approximately 80% share in the overall cumulative investments. In the healthcare delivery segments, which is essentially hospitals, we have seen investments close to $2 billion by both mainstream and impact investors, and majority of the investments have gone into the multi-speciality hospitals, which currently account for 55% of the share in the total cumulative investments. Now, hospitals in India, by the very nature, have a great growth potential, and by 2020, it is estimated that the total size of the hospital industry may reach close to $150–160 billion. There are few emerging trends that we are seeing in this healthcare delivery space, which will be a good option for investment from an impact investment standpoint. First, there are few business groups who are setting up hospitals in the primary and the secondary care around the peripherals of the main tier 1 city. So they're not catering to the main city, but they are trying to create a market around the main city, around the periphery. Now, they are establishing a hub and the spoke model by setting up units around the main city. By this, they are capturing the large underserved population which stay at the outskirts of the city. And we believe that will be a good investment option, and it's like slowly emerging in India. The second trend that we are seeing is a regional play in the hospital space that has been adopted by a few groups in India. They have a very good understanding of the local ecosystem, and hence they are only focusing and growing in that particular region and mainly targeting mid to low income states in India. To us, again, they have a great growth potential, and hence, a natural investment inclination should occur for them. The third trend is a platform play that we see in India. Now, that is not very prevalent in India, but is slowly, gaining momentum. Now, basically, there is a lot of interest from the strategic investors to form, and these are like, international investors, to form a platform by partnering with a local hospital group in India. And once a platform is created, it can be used for acquisitions by leveraging the relationships and understanding of the local partner. Now, the financial investors here can potentially look to invest in these platforms, and that's it for the healthcare delivery space. On the pharmaceutical front, there are a couple of emerging trends that we see. One, there is emergence of alternative medicine market in India. Now, these markets already existed in India, but are slowly kind of gaining more prominence as compared to a standard medicine. Now, they are mainly into Ayurveda, naturopathy, and homeopathy. And the size of this industry, what we see is currently it's around $10 billion, and it's set to become around $15 billion in the next 3 to 5 years. And there are plenty of companies that are sprucing up in this particular space, in the alternative medicine space. The second segment that we would like to talk about in the pharma space is an offshoot of pharma, is the nutraceutical segment. Now, many pharma companies that we are seeing now are diversifying their product base into the nutraceutical segment. Now, these segments essentially cover dietary supplements like vitamins, minerals, protein supplements, and also functional food and beverages, which includes sports and energy drinks. Currently, this market is around $2 billion, but we expect it to be around $6 billion in the next 3 to 5 years time frame. In fact, talking about nutraceuticals, most of the companies are trying to integrate themselves backward, by having control on the crops, which are the essential raw materials that go into these nutraceuticals. By controlling the crop patterns, and hence the control on the yields and better margins. So that is a trend, that we are slowly seeing, that has been followed by few of the companies in India. In the last section of healthcare, we'll talk, briefly cover the medical devices segment. Now, currently, this segment is focused on manufacturing low-value items in India. The higher-end devices are currently imported in India, and there has been a recent change now on the regulation front, and the government has now notified the medical devices rules in the current year, which is expected to provide a boost to the medical devices manufacturing segment. And slowly we are seeing increasing interest from the investors in this segment. With this, I would request Avesh to talk about the other two sectors and conclude. Thank you.
Thank you, Samir. Looking at the financial services sector, what we feel is there are some key themes that are emerging that are attractive for impact investing. So, for example, companies that fund MSME or SME companies, and they are really very interesting to look at, because what's happening is that since India is also growing, there's a huge opportunity for many MSME and SME companies to grow, but many of them may not have collaterals to give to for banks to fund them, or they may not have a very long history or profitable history. Many banks hence cannot fund them, and they don't have access to capital then to grow. So many NBFCs have started looking at this and have started funding many of these MSMEs. That essentially is giving a very great return for a lot of these NBFCs, and we've seen a lot of capital getting into these MSME companies that are really, MSME NBFCs that are really helping these small companies to grow as well. We've also seen a lot of interest in agri-financing lately. There's been huge interest in irrigation facilities in India, and hence a lot of NBFCs have started to look at funding irrigation facilities for farmers, because there is obviously a lot of return that the farmer can get once he puts in the irrigation facilities. Also, we are seeing a lot of interest in post-harvest grains funding. Essentially, these could be as collateral managers that are coming up in the Indian context, and a lot of funding is going to these grains, etc. in that context. Also, interestingly, what's happening is that since there's been a lot of crop insurance that is happening in India, whereas dependency on monsoon is lesser and lesser, a lot of agri-financing is happening, and that's one of the interesting sectors to look at right now. Another interesting sector in the financial services, of course, is the new age lending models that are coming up, which are using a lot of innovative ways for credit verification and quick verification, in fact, also to lend to these individuals. So we've seen a lot of traction there. Also, things like the business correspondent model is picking up steam. A lot of investors are investing in that space. Essentially, business correspondent model is that they would be the feet on the street for a lot of banks and NBFCs, do a lot of groundwork, credit verification, fund distribution and collection, whereas the loan would sit in the bank's books. So a lot of companies have shown interest to fund these companies. Talking briefly about the agri-businesses and where we see our attractive opportunities to invest in, we've seen a lot of opportunities in the agri-input space. Various companies are doing extremely well who are focusing on things like farm mechanization, whereby they're helping farmers increase their yield. Organic farming and organic value chain is also seeing a lot of interest at this point of time. Then agri-logistics is also something that we've seen is of great interest. Obviously, there's been a huge wastage in the Indian context, right from the produce till the time it reaches the consumer, and a lot of companies are trying to minimize these waste. A lot of capital is going in to help these companies to do so. And then last but not the least, a lot of food processing companies have also been raising capital. There's a lot of interest because what they're doing is they're not only they're profitable, but they're also providing the right amount of realization to the people or the farmers from whom they are picking up these raw materials for themselves. So this is also showing a lot of attraction in the impact investing ecosystem. And with that, we would like to conclude and take any questions. Thank you.
Thank you, Samir, and thank you, Sarvesh. We'll go to the first question. The question is, what is the minimum ticket size of investment of an impact investor? What is the typical size of investment made?
So this is Sarvesh. There is no minimum size of impact investment. So obviously, what impact investing is investing in the enterprise rather than the capital. So even if mainstream investor is investing in an enterprise, that can be considered as impact investing, even though the mainstream investor's objective wasn't there. Similarly, even when the enterprise starts and raises its first capital, essentially it has its friends and families to take funds from, and it could be as small as even 50,000, for example. So there is no minimum ticket size, so to say, for impact investing.
Just to add to what Sarvesh is saying, while there are no minimum size, what we are seeing is increasingly right now companies and the investors rather are preferring to invest around $1 million or $2 million at the minimum.
Thanks. What is the nature of financial returns, that is the annual dividends? Samir? Yeah.
Yeah, I'd like to take this up. So essentially, the way the impact investors are operating in today's markets, they operate very similar to a standard, equity investor. So there are no particular, annual dividends that gets promised to them. Most of the investments that are flowing into the sector today are, proper equity bets that have been taken by them without, any fixed dividend kind of yield promised to them. From an overall IRR perspective, yeah, there might be some expectation depending on the investment, but there is no annual outlay of dividends in the sector that we are seeing.
Okay, moving on to the next question. What is usually the largest contributor of risks in impact investment portfolios? How do these risks differ from the risks that investors take in traditional capital markets?
Okay, this is Samir. I'll like to take that up. If there's a comparison between a capital markets versus a private investment, the most important risk that the impact investors are taking today are on the business and the scale itself. Because on the capital market side, the companies that get listed have a defined business model and are relatively stable when it comes to the life cycle. Whereas the companies that are backed by the impact investors are slightly early phase companies, and hence the business risk and the scalability risk are of higher prominence to them as opposed to a standard equity capital market listed company.
Okay, the next question is, what are some of the impact measurement strategies used by investors?
This is Sarvesh here. So these impact measurement strategy, essentially, different investor could have a very different impact measurement tool. But many of the times, obviously, it depends on the sector you're funding. If it's for example financial services, then they would track things like how has your loan improved the ability of the family to increase its revenue. If it's the education space, then they see that what has the person done after you helped them with education. If it's vocational training, how much of increase in your income generation has happened post taking the training. So different measurement tools depending on the company in which you are funding and the space in which the company is looking at.
Okay, thank you very much. We do not have any more questions as of now. However, if you have any questions from amongst the audience, please feel free to write to us at india@avpn.asia. We will be posting the recording of the webinar next week, so look out for that. If you want to know more about AVPN or the AVPN International Conference at Bangkok, please refer to our website 2017.avpn.asia. Thank you, Sarvesh. Thank you, Samir, for this interesting session. Thanks, everyone, and look forward to engaging with all of you again. Bye.
Thank you all. Bye.
Thank you.